Well, Ron, why don't you go ahead and did you see one of the questions? I thought there were some really good questions actually coming in while
Yeah.
we were talking. Go
So
ahead.
so
Why don't you
I'll ask.
address one?
Yeah, I'll ask this question right now. And since I talked about strategic and financial buyers, I'll throw it to the two of you. Should I pursue a strategic or a financial buyer, and who's going to give me a better value?
That to me?
Yeah, go ahead.
Yeah, I mean, I would say that, strategic buyers, typically, aren't, as much cash buyers as private equity. Private equity, as you have taught me over the years, is that, private equity, they typically aren't earnout structure, because, they're coming in, they're looking for an investment, and they're making that, so I think strategic buyers probably want to structure more, financial buyers are more cash at close, but strategic buyers are also high cash at close. It's all part of the negotiation. In terms of the value, I think in this market today, I think that, financial buyers are probably not going to pay, the same value that a strategic is, because they don't really get the synergy, right? So even in this market where file counts are down, margins are a little bit tighter, they don't get the synergy that a strategic buyer does. And I think we've talked about all these big companies buying maybe smaller companies, but realize, just like Richard and I did, years ago, is like sometimes small or mid-sized companies come together, through an acquisition and ownership sharing and things like that to create a mid-sized company. And I think we're going to see a lot of that. So and that's going to be, those are strategic buyers. So I think strategic buyers are in this marketplace with debt markets going where they're at. I'm focusing personally more on strategic buyers.
Yeah. Hey, Jan, I'm going to ask this next one of you, because I think we've seen a lot of this in the last couple of years. How significant is the average length of a client relationship and or clients under contract in determining valuation, multiple, and purchase premiums?
So one of the questions we ask our clients and that buyers will look at is client concentration. Again, talking about risk, the higher your client concentration, the greater the risk to the buyer, because if you lose a client, it has a greater impact on your revenue stream. At the same time, if you have a client under contract, the risk is lowered. So the answer, the simple answer is, the more clients you have under contract, the less risk, and therefore the higher certainty of revenue stream, the more likely you will get a better valuation, and will also have a much greater certainty of achievement of post-close earnout. To the extent that you have client concentration, high client concentration, whether your biggest clients are under contract will be a significant factor. We have one client right now that we're working with that has significant client concentration, and that has become an issue in the transaction precisely because even though they've been with the company for 20 years, they are not under contract. And buyers are very concerned about the risk of that, and they want to deal with that through structure rather than valuation and cash at close.
I knew you could answer that. Let's go to this one. I think that this is real important in today's world, because I always say PPT, people process technology. Chris, I'm going to throw this to you. How do you see a company's technology playing into deal price?
I think it's critical. We're talking to the company that is that the value of the tech is maybe $10 to $20 million, right? So I think sometimes people are prouder of their baby, as we like to call it, when you're building tech. They're really proud of their baby, and it's not as good as they think it is because it's what they use every day, But if it is very strong tech, there are companies, strategic buyers and then financial buyers for sure that, want to invest in that. Then there are other buyers that, they're already on one of the main software platforms and they want to switch everybody to that platform. So you have to bring the right buyers to that company, and, it should greatly increase their value if the tech is real.
I'm going to answer a quick question. There was a question here. Is venture capital and private equity the same? It is not. Venture capital is early on investors. Sometimes they're called angel investors. It's usually tied, not always, but usually tied to technology in some form or fashion. So that's the way we see, and I think the industry would probably describe it that way as venture capital. Private equity is much more risk adverse, so they want established companies with established EBITDA, established cash flow, as we've mentioned before. You know, I'm going to throw this to Jan. It's a really good question. How does substantial retained earnings in a small to medium-sized privately held company factor into the valuation in addition to good EBITDA?
So we have to start with the caveat that we are not tax advisors. I like to say I know enough tax to be dangerous. It's dangerous enough that I do my own tax return. So retained earnings in and of itself only matters in an S corporation. And the reason is because in an S corporation, you've already paid the income taxes on those retained earnings. You just have not distributed them out yet. So you're carrying them in the company. If you are not an S corporation, that's not the same analysis. So again, I would advise you to talk to your tax advisor. But the other issue is retained earnings, again, it's a balance sheet item. You get valued on your P&L more than your balance sheet. What matters about the balance sheet is we do almost all of our deals in what's called a cash-free, debt-free structure, which means that the buyer does not get to keep your cash, but the buyer also doesn't take on your debt. So you have to, before the close, you have to pay off all the debt, and then whatever cash is left over, if there is any, you get to take that. The problem is that there's another requirement called net working capital. I won't go into great detail about it, except to say that you have to deliver the company with enough capital for the company to keep running at the level that it was when it was sold. And so the cash that you would normally take might not come to you because you might need to provide that as part of the net working capital. The retained earnings only matter to the extent that they have been translated into cash.
Great. We've been asked to cut this off at 10 after the hour, and I still see that we have a pretty large audience, so I'll continue for the next 7-8 minutes just asking questions, unless Megan, you want to jump in here. So my next question, which is a fantastic question, I've never been asked this before, but I like this question, Chris. I'll give this to you. A heightened interest in M&A means more companies. They just lost. A heightened interest in M&A means more companies are trying to get out of the industry. Doesn't that indicate the whole international logistics industry is contracting, which means your company's valuation will be less than it would be in an expanding market?
Well, I don't think global supply chains are going to be retracting. I mean, you may go have a little dip, but every trend is that. You know, we just had some of these people are parts of the WCA. We just had a booth at the WCA in Singapore just this week. You know, globally, you know, the industry is booming, right? You know, so you know, and I don't see any of that changing. So I wouldn't really look at global supply chains as retracting unless I'm misunderstanding that. And I do think that, you know, there's going to be a lot of startups. There'll be new companies coming in, small companies coming together to build mid-sized companies. It's not what I would call a retracting industry. It's not like the travel agent industry, you know, when the internet kind of came over and put that business out of existence. There's some worry that, you know, the carriers, like you mentioned, Maersk, et cetera, you know, they're going to retract that market for the freight forwarders and customs house brokers. But, you know, we've all been in this industry a long time. There's been initiatives like that in the past. And, you know, the men and women that have built this industry are pretty tough and pretty good at fending off competitors.
Yeah. 2 questions here on valuation. I'll take one and then I'll pass the second one on to Jan. I'd like to sell my business. My company has 10 employees. My CPA evaluation last December placed it at 8 million. What are my options in the M&A space? You always have options. That's the good thing. The problem is that we get this a lot where a agnostic or a non-industry specific CPA, been a friend, been a family friend, been in the business for a long time, but really doesn't know what the market is. I can't tell you what an $8 million valuation is. Sometimes people see valuations tied to revenue, and that doesn't happen in our industry. It's very rare. That's a technology valuation. That's an e-commerce valuation. It's not tied to our industry. So you got to be specific in there, but more than willing to talk to you guys about that. Second question, short question, long answer, Jan. What are high valuations for broker CHB?
What day?
I knew you'd love that question.
What day and what broker? This is the question we get asked all the time, which is, what's the multiple now? What's the multiple now? So what I can tell you is we've sold companies with double-digit multiples. We've sold companies with middle to low single-digit multiples. It really depends upon how you are doing and where your value differentiator is. I always say that every business has to have a differentiator. Why should somebody use you rather than your competitor? So depending upon your differentiator and depending upon how valuable that differentiator is in the marketplace, that will affect whether you get a high valuation or not.
And Chris, we might finish on this one because I think it's a great question to finish on. And I know we've done a lot of work in this. Let's say I want to sell my business in 3 to 5 years. What do I need to do now to maximize the value of my company?
That's a great question, and that is how you should be thinking, right? And then the other thing is, if you have to think about if you're thinking I want to retire in 3 to 5 years, realize that most buyers don't want to come buy a company and then you walk out the door and leave, right? They want to buy the company because of what you built, and they're going to want you to stick around for 2 to 3 years. So if your idea is that you're going to get to a certain point and retire and then just turn the keys over, that doesn't typically happen. So you should plan for that. To get ready for that process is, you should, if you're planning on running a process tomorrow, I wouldn't suggest changing your technology, right? But if you're planning on 3 to 5 years and you have weak technology, that's one area you should probably fix and invest in. You probably want to start running your company very clean, right? You want to keep your costs. You want to focus on your EBITDA number, but I wouldn't say, focus on, cutting costs, right? Because sometimes, the best thing you can do is put more money into the business, into marketing and sales, and get more aggressive, right? So it's really, you're obviously trying to get to higher bottom line, because again, our industry is not valued on top line, or it's based on the bottom line. So you want to drive money to your P&L. And as Jan mentioned on the balance sheet, you're going to keep the cash that you have in the business. So put enough money into the business and try to build the business over that time period. Well, I see Megan has jumped back on. So Ron, you asked the right last question. Hi, Megan. I think, Megan, you're freezing. So Ron, I think we're good. Do you want to just end us out? Or
Yeah,
Megan?
so all I would say is, Megan, can we hear you now? I don't know. Nope, Megan's frozen. So all I'll say is thank you everyone for your time. As Chris mentioned, we're going to be at the annual conference in New Orleans. Would love to spend some time with you. We do a lot of networking, a lot of talking with people. We understand it's very, very, very complicated. I know somebody asked, and I couldn't find the question, but somebody asked, I have a $10 million, I have less than a $10 million company in EBITDA. Is there a marketplace for you? There's a huge marketplace for you. Well, one of the statistics that I like to use, because I like to read a lot, we all like to read a lot, and share that information with our clients and prospects, is that Last year, 70% of all transactions were in the small to mid cap transactions. If you're sub $10 million and you want to look at either buying or selling, that is the perfect marketplace for multiple different types of options for you. You might even be a platform depending on what you do for somebody. So don't think of yourself as small if you're sub $10 million. Thank you, everybody. We appreciate all your time. Look forward to seeing some, if not most of you. Incredible audience. Thank you for sharing my birthday with me. I don't know if that's a good thing or a bad thing, but hey, I'm still here, so that's a really good thing. So thanks a lot. Have a great week, and we're always available if you want to talk.
Thanks, everybody.
See you. Cheers.